Bloomberg Audio Studios. Podcasts, radio, news. This is the Bloomberg Surveillance Podcast. Catch us live weekdays at 7 a.m. Eastern on Apple CarPlay or Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube. Joining us right now from Standard Chartered Bank. Just an open question to begin. Mike Mayo coming up as well, and Freya Beamish to get you prepared for Global Wall Street this morning. What is a single thing you're focused on now in the cacophony of news flow?
Well, first let me say that Barry Eichengreen and I were classmates at Yale in the PhD program in the 70s. I doubt I'm in the book, but we do have a connection there. In terms of what I'm focused on, I mean, longer term, I think it's all productivity growth. That's the biggest factor driving the economy. It makes everything possible. If, Powell is correct, if Warsh is correct, if we are correct, that it's surging, we're kind of back to the late 90s, which was a very good period for us. But that's in the medium and long term. Shorter term, I think we're going to see U.S. policy become more cautious. I mean, the focus being the midterm elections, doing a trade deal with India is a positive, sort of threatening to invade Greenland is a negative. So I expect the temperature to really calm down and dollar to appreciate very gradually, get rid of some of the risk premium that accumulated in January.
So I guess that January was a tough time for the dollar. The dollar weakening. We haven't seen the dollar bounce back from that April of last year. Is this the new normal for the U.S. dollar, do you think?
Well, based on our equations, what we saw was that the risk premium zoomed. At one point, it went up to about 8%, right, in April. Mm-hmm. But then it converged back to, normal levels. And then it reopened again, went up to 5-6%, during January. And it goes up really fast when something dramatic happens, and it comes down really slowly when things get normal.
So we think you're expecting a recovery in the dollar gradually going forward here in 2026?
Yeah. Largely. I mean, there are risks. I mean, if the Supreme Court bounces the IEEPA tariffs in a big way, compromising not just the revenues that they've already collected, but future revenues, that's going to really hit the dollar. And we'll probably see bond yields go to the moon off that, because the fiscal path will be even worse than it looks right now.
I look, Steve, at the dollar dynamics, and the basic idea here is the dollar is overvalued. For example, on yen, we're going to see a big move for this, that, or the other reason. Explain why we want a weak dollar. The president wants a weak dollar. Do we want a weak dollar?
I don't think so. There are paths by which a weak dollar represents a positive outcome for the U.S. For example, say the rest of the world decides on fiscal expansion, and so their interest rates go up relative to ours. Our currency depreciates, but there's more demand. Everything is fine. But most of the other paths, and I'd say the majority of paths, are actually negative for the U.S. They represent a loss of confidence, either in fiscal policy, geopolitical policy, the U.S. markets.
So
and that's a
going back
negative.
to Eichengreen, is it a seismic shift across the history of what your colleague at Yale is expert on?
I haven't read the book, but I'd say that most of the market is to predict seismic shifts every 3 months or every 6 months. It takes a lot to get a seismic shift. I don't think we're there yet. I think there's still a lot of positives for the U.S. dollar out there.
Where's value out there in the currency markets today?
We like Aussie and Kiwi. We like
the Aussie and the Kiwi.
Yeah, and we like high yielders. Brazil. We're still sort of concerned about Europe. Sterling's having a good week, but we don't think it's going to, carry on for an extended period. Canada is vulnerable because of, the poor relations that Carney has with Trump at this point.
So talk to us about the euro here. We saw in the beginning of the tariff discussion, Europe really step up some of their spending, whether it's for military spending, infrastructure. we kind of felt a little bit more positive about Europe. Is that something that's sustainable, or was that kind of a one-off there?
I hate being a poor guest and correcting you. We saw Europe step up talk.
Yes,
more fiscal spending. It's yet to be seen how much room there is. Germany clearly has room, but that's disappearing because their entitlement spending is going way up. So in 2 years, that room may disappear. Most of the rest of Europe doesn't have room, and it's not clear where it's going to come from. So we'll have to see what they deliver.
Yeah, the euro 118. So there goes.
I look at these moves, and I guess my question is, like, we got to go back to Japan in terms of the excitement of big figure moves. Are you in a Steve Englander big figure moment here, or is it a grind through 2026?
I think if we're right on the dollar, it's going to be a grind because it takes a while for the market to buy into long-term theses. If it's really the case that the U.S. economy is more robust, productivity growth is picking up, capital flows, both equity flows, private equity flows, direct investment, and as we think real interest rates pick up, fixed income flows pick up, but that's a very gradual process. The bad stuff is higher frequency, and that's more short-term.
Stephen Englander with us. Michael Mayo is scheduled to be with us here just in a bit, and then Freya Beamish, very strong moment for Global Wall Street. Tie your currencies as litmus paper for everything else in the markets, including commodities. I mean, Standard Chartered has such a good perspective on that. What do currencies tell you now about a potential commodity boom, or what China's going to do with commodities, or the equity markets in the Western, the Atlantic sphere?
Well, my colleague, whom you know, Suki Cooper, had been saying...
She's lights out.
Fantastic. And she'd been saying last week that it looked like some of the commodities were overbought. Now we've corrected. And I think, so far you're beginning to see people come in. It could end up being a healthy correction rather than a bad one. In terms of currency impact...
Right.
You look at, say, silver or gold against, pick a currency, euro, right? That's appreciated against the dollar. The chart looks almost exactly the same. I think what you're seeing is the world has concerns about fiat currencies in general, maybe from time to time a little bit more about the dollar, but it's not like the European fiscal situation is golden, the Japanese fiscal situation is golden. Any of the major currencies have strong economies that you can really count on on a sustainable basis. So I think we're looking for, or the world is looking for stores of value that's not a fiat currency.
What was class like with you and Eichengreen sitting in chairs, dumb PhD students? Like, name it, were you there with Schiller? Was Schiller or Modigliani?
Yes. Not Modigliani, but Schiller was there for part of my time. I'd say Eichengreen was never dumb.
No, he's been a huge support, but between the two of you, that's some intellectual firepower to say the least.
And one of the things, he was very capable. I think he was one of the first in the class to finish their PhD. So, he really was focused.
Yeah. I should point out that his thesis was Golden Fetters, which became this absolute must-read. If you didn't read Golden Fetters, you didn't get to play the game. We'll get Professor Eichengreen in on his new book, which is hugely anticipated. It's like Rogoff, a sprawling history of foreign exchange, and no doubt Englander will read it cover to cover. Thank you for coming in today.
Always a pleasure.
Stephen Englander, Standard Chartered Bank there with some real movement. Stay with us. More from Bloomberg Surveillance coming up after this.
You're listening to the Bloomberg Surveillance Podcast. Catch us live weekday afternoons from 7 to 10 a.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app, or watch us live on YouTube.
Freya Beamish with us right now with TS Lombard, just with brilliant work, and particularly on Asia. Paul, this could be like an hour chat.
Totally, absolutely.
We could block out the time.
Their offices, TS Lombard, literally across the street from Bloomberg in London.
Yeah, I know.
Yeah, it's awesome.
They're there.
I mean, we're neighbors.
They go over to the Royal Exchange.
Yeah, I know.
Go to Boodles. I've seen Freya in Boodles buying something before. Wonderful to have you in our studios. Let's go American right now. You are quite the student of a labor dynamic, a capital dynamic, a total factor productivity dynamic. Do you really believe, as Stephen Englander does, that we have a new productivity?
I believe in there being stronger structural productivity growth vis-a-vis like the 2010s when you had austerity and monetary policy was the answer to everything, and cheap labor was the answer to everything as well. So productivity growth at that moment in time was very weak. And now we have the sort of the reverse of that policy as things stand, and we have a new technology and the economy is being run hotter, and so it's likely for that to be adopted. It's probably also likely that that will diffuse out into the macroeconomic statistics more so than being just captured by a select group of sort of big US firms in a profit sense as well. And so that's all sort of good for the structure, and we see that already in the data. But I think a lot of that is already in the price for the US, where it's still untested, and I believe in it for the rest of the world. And then for last year in particular, I think there's a lot of sort of weird statistical stuff going on that perhaps flatters the productivity outturn for the US. If you think about sort of how does AI show up in the productivity statistics last year, it's like AI capex is in the numerator, and all of the uncertainty over tariffs is in the denominator. So because nobody's hiring, so of course productivity is going to be temporarily higher in that environment.
Well, that's certainly what I think the Fed chair nominee is banking upon AI improving productivity, which would offset perhaps any inflationary issues coming from lower rates. I don't know. You're an economist. Does that make sense to you?
That's why they're going to be late in realizing that we still have one more cut penciled in for this year, precisely for the dynamics that you're sort of highlighting. But I think at some stage we're going to see a bottoming out in wage growth in the context of dropping a lot of fiscal demand into this economy. So 0.6% of GDP coming into the middle income section of the distribution through refunds. Probably there'll be like stimulation of the bottom part of the K that was a bit unhappy in the gubernatorial elections. And so that demand coming into a very dislocated labor market where the NFP break even is probably about 30 at most.
So this is a core theme of Adam Posen and Peter Orszag in their essay of a couple of weeks ago, looking for persistent, resilient inflation, and dare I say, a higher inflation. Are you in that camp where the wage dynamic, the labor dynamic, gives us a higher yield structure?
Yeah, I think so. I mean, over the course of this year, we're not actually that far above consensus on our CPI number, just because shelter's there and energy is all kind of dragging that down a bit. But in terms of like the leading indicators for 2027 and how the narrative could shift over the course of this year, how that could get played out in the longer end of the curve in the bond market, that seems to be the shift that is going to happen over the course of, maybe not immediately, because there's so much of a tailwind behind this kind of productivity story. That's the sort of the new Fed chair. That's his boosterism that he's pushing, and that gives them a little bit of time. I wouldn't want to run against the equity market when you've got all this fiscal policy coming into the pipeline. But over the course of this year, I think the narrative is going to shift to actually what does this mean for the labor market, and what does this mean for the underlying trends in inflation, which are probably going to be higher, particularly in the context of deglobalization.
In your talking points, you highlight Japan, which is great because this is a crazy story to me. When I started my career in the 80s on Wall Street, you had to be in Tokyo because that's where all the action was. And we were there and we were doing deals. Then it died for like a generation plus. Now people are talking about it more. What's your call on Japan here? Is this a flash in the pan or is this a renaissance?
I don't think it's a flash in the pan, but I think both the renaissance and the crisis calls are overblown at this moment in time. On the renaissance side, I think yields are rising because of that renaissance, right? I've gone back to European pronunciation now, but they're rising because of that renaissance. Nominal GDP growth is higher, and therefore yields are higher as a result of that. Doesn't immediately mean fiscal crisis when you have an 8.5-year average maturity on the debt, because it's the effective interest rate that they're paying. So it takes a huge blowout in term premium, not just a sort of a normalization based on the fact that we're moving from a savings-led deflationary regime to a regime where there's actually some degree of competition for funds. So I don't think we're in a fiscal crisis, but I also think in terms of inflation downside surprises, which is a key trigger for the yen, that could start to come through if you think of nominal GDP growth, where that will be and where inflation is probably going to pan out at 1.5, not 2%.
In our studios with fabulous work at TS Lombard, London, her work at the London School of Economics and the University of Edinburgh, Freya Beamish with us today. ADP out at 8:15. I guess more important because I don't have a Friday jobs report.
Nope.
Right now. I don't think that'll change. McKee says no. The revision cut a little lower. The survey was 45,000. It came in at a paltry 22,000. Mortgage applications with a negative statistic. Okay, that's tertiary. Paul Sweeney will have the ISM Services Index for you at 10 o'clock as well. I guess I've just got to ask you about China, Freya, with your fabulous work over the decade on China. Is there 5%? You talk about nominal GDP. Do they have a legitimate 7% nominal GDP?
Maybe not 7%, certainly not sort of a trend, but we are above consensus on real growth this year, so sort of 4.8%, and probably inflation a little bit less low and less deflationary than it was last year. That's more of a sort of a tactical call, probably just because there's like a lot of stimulus coming into the system in the first half.
Do you see them moving everything over to Malaysia, everything over to Vietnam? You know, basically just saying to President Trump, I'm sorry, we're going to do an end around?
I think that's a sort of a trend. I think the American authorities are sort of onto that to some degree. Certainly, when we look at who they're tariffing and who they're sort of lashing out against, there's those other countries are sort of there. But I think there is also a concerted shift and a realization that consumption is now a question of national security. Reorganizing the economy towards consumption is a question of national security. Whether they'll be successful in that in any kind of positive sense is more of a question. But that reordering towards private consumption is certainly enough to sustain the tactical rally for the moment. There might be a little bit of a buy the rumor, sell the fact, and March is the point when the fact comes in. So I'll be a bit more worried about the equity market at that point in time.
Freya, when you talk to your UK and European clients, do they feel like the UK, Europe, they're really on their own now? They can't. There's globalization, the trade relationship with the U.S., it's fundamentally changed. Is that the belief?
Yeah, it has fundamentally changed, but partly as a result of that and partly because of the political instability that is rising within Europe as well as across most major economies. There is a domestic response and a reordering towards domestic demand, and the German fiscal policy that's coming through, I think, is also potentially a good thing for equities. We were never big believers in the export-led growth model as a driver of equities for EMs or for Europe. So we can't now start crying about how the export-led growth model is dying when there's something there that does appear to be replacing it, partly as a result of all this chaos.
Freya, thank you so much for coming in. Just wonderful to have you here today. With TS Lombard London, Freya Beamish with us, Chief Economist. Stay with us. More from Bloomberg Surveillance coming up after this.
You're listening to the Bloomberg Surveillance Podcast. Catch us live weekday afternoons from 7 to 10 a.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
You know, as Paul's been brilliant on this. I mean, DXY like a rock. DXY, the blended major trading currency like Bloomberg Dollar Index, a 97, a 97, it just won't give way. I mean, everybody's going weaker dollar in that. Long ago and far away, there was a bank roll-up, and I don't have the numbers in front of me, but there was like 16,000 American banks. Now there's under 5,000 American banks, and someday we're going to be like Canada and have 5 banks. Someone that's been just absolutely legendary and following, saying, yes, we'll get to Mike Mayo on Citigroup as well. What a moonshot that is. Mayo finally gets Jane Fraser to behave herself and get something done here. But today, with Webster Financial of Waterbury, Connecticut, boys, they're going to be taken out by Santander Bank. It's like a new era, you say. Good to see you.
Nice seeing you.
You look great. I mean, you know, I look at this and you're giving me this as a new era for bank mergers. We've said that like 5 times. What's different now?
Well, you have night and day difference in bank regulation. This is once in a generation deregulation. Since the financial crisis, regulators didn't want banks to merge so much. And now it's back to the future. When I worked at the Fed 35 years ago, we approved bank deals in 90 days. And guess what they're back to doing? They're back to approving deals.
Is that a one-off with Trump? And after President Trump, we see something different?
No, I think there's a realization that the lack of bank deals was a gift to Jamie Dimon. I mean, you just prevented a lot of...
I happen to agree with this, but continue.
Yeah, no, bank mergers are needed instead of just having, Goliath is winning.
Yep.
JP Morgan's the Goliath of Goliath. And to put this in perspective, the bank that just sold to Banco Santander, JP Morgan is going to spend about $20 billion on tech expenses this year. That would equal 15 years of the bank that just sold's total expenses. So how do you compete if you're a small bank? Scale is more important than ever before in banking. So you have the need, you have the ability with the regulation, and it's happening. It's just getting started. This is a new era for bank mergers. Once again, Tom, as you may recall, in the 1990s, that's when I made a name for myself with our bank franchise value model. And this morning, I reintroduced that bank franchise value model to highlight hidden values at banks.
Do you have to pay a royalty to Credit Suisse? Paul Sweeney, jump in with Mike Mayo.
So, Mike, how is this merger wave going to look like in the bank space? Is it the regional banks, just regional banks merging? Are we going to see creation of more super regionals? How's that going to look for us?
I think it's going to be banks that rank 20th to 100th in size. And I think you'll see, deals where you have undervalued banks. And remember, 2023 wasn't that long ago when you had some regional bank failures.
Yep.
And several banks were looking at the abyss. And their long-term value is debatable, but their short-term value is still very much there. So I think these kind of mid-sized banks, have their moment of reckoning. And I think this is a window too, where I think mergers are, tolerated, encouraged. And that might not last forever, like after the Trump presidency, but it should.
How many banks will there be in 5 years? I mean, am I right? We went from 16,000. It's like Thomas showed it. Keith Briette would know this. Down to 4,000 banks now, right?
Yeah, we're from 15,000 to 4,600, and I expect the number of banks to be cut in half over the next 10 years.
10 years. Okay.
Yeah, I got a neighbor of mine who I commute with. He postponed his retirement. He's a banker on financial services. He says, I'm going to make a lot of money in M&A the next few years. I'm not retiring. So what's driving the consolidation here? Is it that technology investment that's required? You mentioned JP Morgan versus some of these smaller banks. Is that what's driving some of this consolidation?
Yeah, I think the need for scale has never been more important. But you know what's happening right now? The level of competition in U.S. banking is the greatest it's been since before the global financial crisis. Banks are adding more branches, bankers, marketing, credit card mailings, technology, AI. Right. And so it's competitive out there. And so if you can leverage those costs over a larger customer base, that tends to benefit. So there's an economic reason for this happening.
For Global Wall Street, Stephen Englander with us. Now, Michael Mayo with us at Wells Fargo, Freya Beamish coming up here in a bit. Across America, everyone listening to Mr. Mayo, as they do within the banking business, the Smead family, fabulous value investors. Wonderful, wonderful contrarian track record. Serious stuff. And Cole Smead emails in and he says, you got to ask Mike Mayo about a bank bigger than Webster. And this gets into almost regional and super regional, something like Fifth Third of Cincinnati. They don't have 4,000 employees. They got 19,000 employees. What is a bank like that doing right now?
Well, there's a few idiosyncratic situations where you have exceptional management, and Fifth Third is one of those banks. The CEO of Fifth Third, Tim Spence, he's kind of the next generation Jamie Dimon, repackaged in a different form. And so far, they started off with their acquisition of this bank called Comerica. It was headquartered in Dallas. It just closed this past weekend. And amazing, their targets that they were looking for next year, now they expect to achieve in the fourth quarter of this year. And they think out of the box. They've had good technology. This merger is off to a great start. So I'd say they're the exception to the rule in terms of a bank that size.
I want to start a business. I want to build a multi-family residential thingamajig. Is my local bank going to make a loan to me? Are they going to bank me, or do I have to go somewhere else?
No, you can get loans. I mean, for a bank, it doesn't matter what size you are. It's easy to make loans. The hard part is getting paid back.
Okay.
So, in fact, a lot of
good credit.
If you're a customer, you go around, you can shop around to a lot of different banks, and sometimes these smaller banks are the ones who will give you the better terms, looser credit. Frankly, I think there could be more risk with these smaller banks. The reason you had national banking starting 30 years ago was for greater diversification. Remember the rolling recessions? It was it was New England and Texas and California. And guess what? If you had a diversified geographic footprint, less chance of failing. Whereas a lot of these smaller banks, once again, who looked at the abyss in 2023, are not as diversified.
Okay, Citigroup finally with a moonshot, 226,000 employees trading at 1 times book. JP Morgan's at 2.5 times book. Is Citigroup with a story? You finally got it. You finally got your big pop in Citigroup. Does it keep on going and improve that book value?
You say finally got the pop. Yeah, it was the best performing big bank last year. It's still my dominant number 1 pick. So I have a barbell strategy with my weightlifting theme too. We have the takeover target picks, banks like Bank United and Bank of California and Associated. But I also have Citigroup on the other side. And Jane Fraser is turning this company around. And if there's one point for those who cover all industries, how many restructuring stories out there are there that get 7% revenue growth? That's what they got last year. Even while they're restructuring, this is a generational restructuring at a time of generational deregulation. Citigroup is the beneficiary.
Will their distinction be they'll be international more than the other great American banks? What's the pixie dust that's going to drive her forward?
See, you're asking that question the way you would have for the last 50 years.
Why? It could be like a fossil. I mean, Alexis wouldn't have asked it that way. I understand. So what's the new?
The new is they've only had 8 quarters of this new structure. For half a century, they were organized as this global matrix mishmash structure.
Mishmash.
And now they have 5 lines of business, which I say simply payments, banking, markets, cards, and wealth, with a CEO in charge of each of those 5, each with a line of business target, and they are responsible. They all report to the CEO. That's simple but powerful.
20 seconds, single best buy right now, Michael Mayo.
Citigroup, I think in 3 years will be a $200 stock. That's not quite a double, but that's a long way. And by the way, there's no analytical gymnastics to get that valuation. They just go to 1.5 times tangible book value.
Michael Mayo, thank you so much. Stay with us. More from Bloomberg Surveillance coming up after this.
You're listening to the Bloomberg Surveillance Podcast. Catch us live weekday afternoons from 7 to 10 a.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
Newspapers hugely anticipated. Here's Alexis Christoforous.
All right, I've got another Super Bowl article for you guys. I know you loved it so much yesterday, Tom.
Yep.
So this is from the Wall Street Journal. Sunday's Super Bowl, going to be played at Levi Stadium in Santa Clara, but it doesn't seem to be reaping all the benefits you think would go along with hosting the game.
Right.
Why? Well, because its more famous cousin, San Francisco, is ending up with the lion's share of official Super Bowl week activities, and that's despite being 40 miles north of Levi Stadium.
Yep.
So San Francisco, look, it's hard to beat it. You got the Golden Gate Bridge, you got cable cars and Fisherman's Wharf. The mayor of San Jose, which is sort of in the back, right?
Yes,
Santa Clara is sort of in the
city
backyard
right
of San Jose, trying to come back with a roster of events of his own, but it's going to be tough. I saw this stat during the 2016 Super Bowl, which was also played at Levi's. San Fran reaped more than half of the $240 million windfall.
And it's funny because the weather in San Francisco usually foggy, cold. Santa Clara, perfect. My son goes to college in Santa Clara.
Yeah,
perfect every day. I mean, and he, why people don't want to hang out down there versus San Francisco.
It's that allure of San Fran.
It is, I guess. Yep.
All right. I've got another one for you from the Washington Post today. This is about the Boy Scouts, and it sort of caught my attention because I have 2 Eagle Scouts. So
you do?
I do.
Wow. Yeah. That is awesome.
Great. Thank you very much.
I mean, that is
I act
awesome.
like I did it, but yeah, I was very proud of it.
I like when I interview people that are guys are like 50, 60 years old. They still put Eagle Scout on their resume.
Oh, you bet.
Yeah.
It's right there on their LinkedIn.
Yep, absolutely.
So now the Pentagon is warning Scouts of America to make, quote, core value reforms or lose military support. So I didn't realize this, but the relationship between the Pentagon and the Scouts dates back decades. And now the Defense Secretary criticizing the organization for its DEI policies. They allowed girls to join the Boy Scouts 2 years ago, which is why we have the name change, Boy Scouts of America. So, they've got their big national jamboree coming up. I think it's in just a few months. So not having the military spending could be a big deal for the organization. So we'll see. I don't know if they're going to make any changes. Are they going to stop allowing girls in? We'll see.
I was a scout dad for so many years. I hate to camp out, and I camped out every year for like 12 years. I have 3 sons.
It's going to be. It's a mess, to say the least. I mean, whatever anybody's opinion is, it's a mess.
And it's a shame, I think, for the kids at the end of the day.
Yes.
But we'll see what happens.
I was an Eagle Scout.
You were?
I was an Eagle Scout.
Wow.
Well, you still
Way
are.
back.
Once you are,
Once you're an
always
Eagle
are.
Scout,
I
always an
was
Eagle Scout.
Tay House, a really, really interesting troop in Rochester, Tay House.
Oh,
which
give a
was
shout
a bit
out.
of the old school, back, like way, way back old school.
You know how to tie all your knots and
Oh,
all
yeah,
that good stuff.
yeah. Last place in knots, let me tell you. And this is true. We're camping out, Paul, and they said, clean the dish. So I cleaned the dish with soap. Everybody got sick. Great.
Yeah.
Next, what do we have?
All right, what have I got for you? Oh, I like this one. This is from Business Insider. Disney's next CEO often dresses like Bob Iger. Is it a good idea to copy your boss's style?
Yeah.
So apparently Josh DeMauro, who's we know going to take over for Bob Iger, has a fondness for sweaters and white button downs. And apparently they each dressed almost identically at Disney's 70th anniversary last year.
I saw the interview, that long interview on ABC Network News last night.
Okay.
And boy, this guy was fawning over Bob Iger like overboard. It was uncomfortable.
A little syrupy, huh?
Yeah, uncomfortable. I was like, dude, I don't know, but I guess.
What do you think? Is this going to work?
Yeah, I've talked to a bunch of shareholders at Disney. They're happy with this guy, and they think it's all going to work here. So
28-year veteran, so he's definitely coming
I'm
in
still
from
in
the
the camp.
inside.
I don't know how they do creative, even with Dana Walden there.
Yeah. Well, I mean, you've pointed out yesterday and over the days, Tom, that the stock has done nothing for a decade.
Yeah.
8% per year, single-digit return. It had a spike up and then came back. And, I don't have any X in the Disney story, but it's fascinating. Great coverage yesterday, particularly Geetha Raghunathan. Thank you so much for that. Thank you, Alexis. Greatly
You're quite
appreciate
welcome.
it.
This is the Bloomberg Surveillance Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 7 to 10 a.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.